Hello, good day, students. I hope you are doing well. For today, we will be discussing partnership formation. And here are our learning objectives. First, we will differentiate between the accounting for partnership, sole proprietorship, and corporation. We will state the valuation of contributions of the partners and account for initial investment of the partners to the partnership and state the peculiar accounts used in a partnership and identify the transactions that affect these accounts. Okay, to continue, first, let us define what do you mean by partnership. A partnership, this is an incorporated association of two or more individuals to carry on as co-owners a business with the intention of dividing the profits among themselves. Another definition of partnership taken from Article 1767 of the New Civil Code of the Philippines. It defines partnership as a contract whereby two or more persons bind themselves to contribute money, property, or industry to a common fund with the intention of dividing the profits among themselves. Take note that contribution to a common fund may consist of money, real or personal and tangible property. Contribution to industry may be physical or mental. However, a limited partner may contribute cash or property but not services. Now, as to the types of partners, we will discuss more about the characteristic of a limited partner. Now, again, based on the definition of a partnership, two or more persons may form a partnership for profit purposes, and also two or more persons may form a partnership for the exercise of professions, like that of an accountant, doctor, attorney, engineers, etc. But in our case, as accountant, we are allowed to form a partnership as well as sole proprietorship as a business organization for the exercise of our profession, but not a corporation. It is under Section 28 of Republic Act 9268 or 9298, known as the Philippine Accountancy Act of 2004, wherein the SEC prohibits a particular certified accountant informing a corporation organized for the practice of the profession. So to continue, let's talk about the characteristic of a partnership. First, you have ease of formation. It means you can easily form a partnership as long as two or more persons have agreed to a specific agreement as to the purpose of the partnership, what would be the contribution, etc. Second, you have separate legal personality. So it means that a partnership will have a separate legal personality apart from its owner. Third, you have mutual agency. Mutual agency means every partner has the authority to act for the partnership and become binding if such act is within his express or implied authority. That's mutual agency. Fourth characteristic, you have co-ownership of property. It means when a property is invested by a partner in a partnership, such property is no longer owned by him, but by the partnership. And because partners are co-owners, each and every one of them acquires equity over such investment equivalent to their profit or loss sharing agreement. When you say profit or loss sharing agreement, it will lead us to the fifth characteristic, wherein, again, since you form partnership with the intention of dividing the profit among yourselves, therefore, you should have a profit and sharing ratio. You are co-owner of the profit. No single partner is only allowed uh, to enjoy the profit of the partnership. All of the partners will have share of the partnership profit based on their agreement. Then you have number 6, limited life. Limited life because a partnership exists only based on the contract drawn by the partners and can be terminated anytime the partners desire, causing the partnership to be dissolved. So for example, we do have certain instances wherein the life of the partner will be dissolved, or its operation will be dissolved. Like for example, retirement of one of the partner, withdrawal of one of the partner, death of one of the partner, bankruptcy, incapacity. So those are ways wherein partnership can be dissolved. So that is why you will have limited life. Number 7, you have transfer of ownership. Transfer of ownership, it means that this is the same as co-ownership of property, meaning whatever it is that is invested in the partnership, ownership is not entitled to the partner who invested either cash or money or a specific equipment, machine. All the partners will now become co-owner of that particular investment. So that's transfer of ownership. And then you have number 8, unlimited liability. Now, this is applicable to a general partnership or a general partner. Again, as to the types of partners, we will expound this further on the next slide. Now, when you say unlimited liability, this is one of the characteristic as well as a disadvantage of forming a partnership wherein partnership is said to have unlimited liability because the partnership creditors can run after the personal asset of the partners, except for a limited partner. After all, partnership assets have been exhausted in payment of its obligation. Now, to give an example, if ever a partnership will have an asset, let's say 100 pesos, and then it will have a liability amounting to 500 pesos, and then the partnership cannot pay off the remaining obligation in the amount of 400 pesos, the outside creditors can go after the personal asset of the partners within the partnership to pay for its liability. So you call it as unlimited liability in the sense that the creditors can run after the personal asset of each of the partner as long as they are general partner. Okay, to continue. Now we do have these kinds of partners. We have general partner and limited partner. This is according to or as to liability. When you say general partner, this is the one who is liable for partnership debts up to the extent of his personal asset. So general partner, you're liable to the partnership liability or debts up to your personal asset. On the other hand, when you say limited partner, this is a partner who is liable for partnership debts or liability up to the extent of his interest only. So it means if you're a limited partner, the creditor cannot go after your personal asset, limited to your contribution alone. Then we have as to classification as to contribution, we have capitalist, industrial, and also a combination of capitalist industrial partner. So when you say capitalist partner, this is a partner who contributes money or property. Industrial partner who contributes only his personal services, expertise, skills, That's an industrial partner. So the contribution is more on intangible. But if you are a capitalist partner, you contribute money or property, the contribution is more the tangible items. Next, you have managing partner. When you say managing partner, so he or she will manage the operation of the partnership. Liquidating partner, so this partner will facilitate the liquidation of the partnership in the event that the partners agree to terminate the life of the partnership. Dormant partner, this is a partner who has a financial interest in the partnership but does not take active part in running the partnership affair and is not known as a partner. Silent partner, this is a partner who does not take active part in running the partnership affairs, but he is a general partner. And you have nominal or partner by estoppel. Okay, this is a partner who makes no investment, does not participate in running the business, but permit his name to be used either for accommodation or consideration. And lastly, you have secret partner. A secret partner is a partner who is not known as a partner, but actively participate in running the partnership affairs. So those are the classification of partners. But I want to emphasize with regards classification as to liability. We have what you call as a general partnership or limited partnership. But then the rule is, according to our law, if you will form a limited partnership, there should be at least one general partner. The main purpose of that general partner is to absorb all indebtedness or all liability, okay, that is unpaid after exhausting all of the assets of the partnership. Okay, so if you will form a limited partnership, there should be at least general partner, at least one general partner. Okay, to continue, let's take a look at the articles of partnership. Actually, this is one of the requirements. When you're going to register a partnership in SEC, not in DTI, one of the requirement is an article of partnership. So this particular article, it can be constituted either orally or in writing, but it is much better that the article of partnership should be made in writing. And the following essential provisions may be contained in the partnership agreement. So basically, we have here at least 8, no, at least 9, sorry, items that should be stated in the article of partnership. And the partners can also add if they want to have additional provisions in the article of partnership. This is just the minimum requirement. First, you have the partnership name, the nature and purpose, as well as the location. Second, you have the names, citizenship, and residences of the partners, the date of formation and the duration of the partnership, the capital contribution of each partner, the rights and duties of each partner, the accounting period to be adapted, the nature of the accounting records, etc., and the method of sharing profit and losses, the drawings or the withdrawal or salaries to be allowed to partners, and the last one, the provision for arbitration of disputes, dissolution, and liquidation. So again, these are the minimum items that should be stated in the article of the partnership. And partnership or the partners can add additional provisions if they want to, as long as they will agree as to those provisions. Okay, now let's talk about as to SEC registration. When the partnership capital is 3,000 or more in money or property, the public instrument must be recorded with the Securities and Exchange Commission. Again, as I have mentioned a while ago, the articles of partnership can be constituted either orally or in writing. But then, in the case, if the contribution of the partners in the partnership will constitute 3,000 or more, either in money or property, the requirement of the law is that such instrument, your article of co-partnership or partnership, must be recorded with the Securities and Exchange Commission. And it must be in a public instrument. Okay, now let's talk about how do we account for partnership. So basically, the following are the major considerations in accounting for the equity of the partnership. First, we have the formation. So in this case, we will account for the initial investment to the partnership. So this is the very purpose of this first chapter, partnership formation. We will account for the initial investment to the partnership. Second, operation. So in this case, we will talk about division of profit or losses. This will be taken as our next topic. Third, you have dissolution. Dissolution, this is a accounting for partnership wherein they do not intend not to terminate the life of the partnership. They will just dissolve the contract, like they can admit a new partner or withdrawal of a current partner, retirement of a partner, or death of a partner. They will change the contract. They will dissolve the old contract and then draft a new contract. But take note that the operation of the partnership will still continue even though you dissolve the contract. You just change it, no? And then the fourth one, this one, when you say partnership liquidation, this is the time wherein you terminate the operation or the life of the partnership. So winding up of the affairs. So you will sell all your asset and then you pay all your liabilities, whatever cash left, it will be given to the partners as a return of their investment. Okay, now let's talk about valuation of contribution of partners, since this topic is all about partnership formation. So when a partner invests non-cash asset, we're talking about the non-cash asset investment, they are recorded at the value agreed upon by the partners. So depending on the value agreed upon, that's the amount that you will record in the books of the partnership. But in the absence of any agreement, the contribution will be recognized at their fair market value at the date of the transfer to the partnership. Again, for non-cash asset contribution, you will record it first based on the agreement. In the absence of any agreement, or in the absence of any agreement, you will recognize the non-cash asset contribution based on their fair market value. Okay? Now, these particular accounts are somewhat unique to partnership. Okay? So these are the partners' ledger accounts. If you compare this to sole proprietorship, for example, capital accounts, it means that you will have as much number of capital accounts depending on the number of partners. Like if you will have 3 partners, then you will have 3 capital accounts. 4, 5, 6, you will also have 4, 5, 6 capital accounts. So per partner, you will have a capital account as well as a drawing account. Okay? But then, as to the drawing account, one of the difference for partnership recording and recording of drawing or withdrawal In accounting for partnership, you use this account to record the share of the profit or loss. Based on what we learned in the accounting or the fundamentals of accounting for sole proprietorship, the profit will be close to capital. But in a partnership, the profit will be close to the drawing account. So this particular account, aside from the usual or the allowed withdrawal of capital made by the partners, you will also use the drawing account to record the share of profit and loss. Now, if it is a profit, drawing account will be credited. If the share is a loss, drawing account will be debited. And the third account, you will have receivable from or payable to partner. So actually, these two accounts are related to either transaction or a receivable from a partner to the partnership, or a payable from a partner to the partnership. Like for example, if it is receivable from, it means the debtor here is the partner, the creditor is the partnership. So on the side of the partnership, that's our viewpoint, we will recognize this as asset. This is somewhat like the partner makes advances. So we will record this as receivable from partner A, partner B. On the other hand, you will record payable to a partner, where in this case, the debtor is the partnership, the creditor is the partner. Because there are instances wherein the partnership will need cash, but the partners is not or will not have the intention to put in additional capital. So what the partner will do, he just extend money to the partnership. So in this case, we'll record this as liability on the viewpoint of the partnership. So again, the debtor here is the partnership, the creditor here is the partner. So as you can see, these accounts will not see this in the sole proprietorship form of business. Okay, to continue. Now, on the later part, we will have a separate discussion on bonus on initial investment. So actually, this is part of partnership dissolution. But to give you an idea, when you say bonus, a bonus exists when the capital of a partner is credited for an amount greater than or less than the fair value of his contribution. And take note that the bonus is treated as adjustments to the capital accounts of the other partners. Now, to give you an example, so that we can understand what is a bonus on the initial investment. Like, if for example, partners A and B allowed partners C to become a new partner with a contribution of 100,000, but then you will allow that partner a capital credit in the amount of 120,000. As you can see, the actual contribution is only 100, but the amount to be recorded in the partnership books is 120,000. So actually, you call it as bonus to the incoming or to the new partner, wherein the difference of 20,000 will be taken out from the capital of the old partners, A and B. So that is how you treat bonus. On the other hand, it could also be that a partner, for example, partner C, will contribute 100,000, but then the capital credit will only have 80,000. So in that case, the difference of 20,000 will be added to the capital of the old partners, like partners A and B. Okay, so there is such thing as this one, bonus to initial investments. Okay, now let's apply this concept by answering a few exercises as to partnership formation. Okay, to continue, we do have an example here of a partnership formation. Actually, there are three ways to form a partnership. Like first, uh, partners or businesses or will open the partnership for the first time. The second one is this one. This is our example. A sole proprietor and an individual with no business form a partnership, and a corporation will be transformed into a partnership. Now, in our case, I will be discussing a sole proprietor and an individual with no business form of a partnership. Because if it is individual will form a partnership for the first time, you will just record whatever the contribution based on our way of accounting. Like you will record it based on their agreement, the value of the non-cash asset. Then if there is no agreement, you will record it based on the fair market value. Just simple as that. Now, for this example, we will have a sole proprietor and an individual with no business will form a partnership. This is the background of the problem. Hispanol operated a specialty shop that sold fishing equipment, and their post-closing trial balance as of December 31, 2022 is as follows. So Hispanol, the name of the business is Fish, and then the cash is 36,000. The accounts receivable is 150. Allowance for doubtful accounts related to receivable 16,000. Inventory is 440,000. Equipment 135,000. Accumulated depreciation 75,000. Accounts payable is 30,000. The capital of Hispanol is 640,000. Then you will have a total of 760,000. Additional information, it states that Hispanol plans to enter into a partnership with a trustee, associate Kenno, effective January 1, 2023. Profit and losses will be shared equally. Sorry for medyo gagmay ang iyang font. Hispanol is to transfer all assets and liabilities of her shop to the partnership after revaluation. And let me just adjust this one. Keno will invest cash equal to Hispanol's investment after revaluation. So this is the investment of Keno. Will invest cash equal to Hispanol's investment after revaluation. The agreed revaluation are as follows. The accounts receivable will be recorded at 140,000. The inventory will be recorded at 460. And the equipment net of accumulated depreciation, you will have 124,000. And the partnership will operate under the trade name Fish R Us. Fish R Us, that's the name of the partnership. And the requirement you have here, first, we will prepare the opening entries in the books of the partnership. Second, we will prepare the partnership statement of financial position as of the date of the formation. Now, first, we will start with the adjusting entries, even though it is not stated here as part of the requirement. The process will be, we will adjust first the book of Hispanol, the sole proprietor, and then we will close the book of Hispanol, after which whatever is the asset liabilities of the book of Hispanol will be transferred now to the new book of the partnership. So let's take a look at first the adjusting entries based on this revaluation. So here are your adjustments. So first, again, your allowance for doubtful accounts will be adjusted because per agreement, your accounts receivable net of allowance is 140, or it should be 140. As you can see here, the balance of your receivable is 140 minus 16,000 allowance for doubtful accounts. So you will have 130,000 plus, or 134,000. But based on the agreement, it should be 140 net of the allowance for doubtful accounts. So in this case, we're going to adjust the accounts receivable based on the contra asset. So what will happen is that we're going to increase the value of the receivable from a net of 134 to 140. So we will increase the receivable. So what we're going to do, we will decrease the allowance for uncollectible accounts. The adjustment is made through the contra asset. If there are accounts with a contra asset, the adjustments are made through the contra asset, like the allowance and later on the accumulated depreciation. You only have two contra assets. So our first adjustment, we will debit allowance for uncollectible accounts 6,000, and then we will credit Hispanol capital 6,000. As you can see, all of the adjustment will be reflected to the capital account. Either you will debit or credit the capital account. In this case, we are crediting the capital account, we are increasing the capital of Hispanol. So this is your explanation. The second adjustment is pertaining to your inventory. This one. As you can see, the recorded inventory is 440, but then it should be recorded at 460,000. So it means you're going to increase the value of your inventory. So since inventory has no contra asset, you will adjust directly to the asset account. This is your adjustment. You will debit inventory 20,000, and then you will credit Hispanol capital 20,000. Next adjustment. The next adjustment is related to your equipment. It should be net of your depreciation. Now, as you can see here, the value of our equipment is 135,000. The accumulated depreciation is 75,000. So if you're going to deduct the value, net of this is, I think, 60,000, if I'm not mistaken. It's only 60,000. Now, based on the agreement, it should be 124. Okay, it should be 124 net of depreciation. So we are increasing the value of this equipment. So to compute, why is it we've come up with the amount 64,000? Now, this is your computation. 135 less 75,000, you will get 60,000. That's the current value of your equipment net of the depreciation. Okay, so again, the value is 60,000 net of depreciation. Now, to look into the amount with 124,000 based on the agreement, it means that we have to reduce our accumulated depreciation by 64,000. Okay, so that we can come up with the amount of 124,000. So it means that 75,000, it should be reduced to only 11,000 so that we will have the amount based on the agreement 124,000. So 135 minus 11, we will get 124 based on the agreement. So this is our third adjustment. With debit accumulated depreciation, it is made through the contra asset 64,000, and then we credit the capital in the amount of 64,000. So based on these adjustments, your capital account will now have this adjusted balance from 640,000 based on the given, and taking into consideration the adjustments here, all of our adjustments, we credited the capital. So your capital from 640,000, it's now 730,000. Okay, there is a capital increase. Now, once we have reflected the adjustment as to the value of those assets, the next thing that we're going to do is to close the book of Hispanol. So to close the account, all debits will be credited, all credit will be debited. So this is your closing entry. So first, you debit allowance for uncollectible accounts. It's now 10,000. Taken into consideration the adjustment that we made here. And then your accumulated depreciation now becomes 11,000 from 75,000. Accounts payable is the same, 30,000. And then the adjusted capital, 730,000 is debited. And you will debit cash, 36,000. Accounts receivable, 150,000. Inventory, 460,000. And then equipment, 135,000. Now, you have closed the books of Hispanol. The next thing you do is to record these accounts into the new book of the partnership. Okay, so the opening journal entries now in the new set of book of the partnership will be this item. First, we will record the contribution of Hispanol. So as you can see here, we will debit cash, accounts receivable, inventory, equipment with this amount, and then we will credit allowance for uncollectible accounts, accounts payable, and the capital. Notice that, okay, please take note of this. When you're going to record the contribution of Hispanol, okay, as you can see here, you have here a debit to accumulated depreciation, but then when you record it to the new book of the partnership, the account accumulated depreciation is not included. The rule is your equipment or any asset that has a accumulated depreciation, you will record it based on the net value. You will not include the accumulated depreciation because that's a decrease of value. You cannot recover it anymore. Unlike the allowance for doubtful account, still you will record this to the new set of books because there is still a possibility that this account will be collected. So all of the items here in the book of Hispanol is included except for the accumulated depreciation. You record the equipment based on its net value only. You will not include the account accumulated depreciation. Okay, so this is how you record the account of or the contribution of Hispanol. And then the contribution of Keno, you will have same amount as Hispanol, debit cash 730,000, and then credit Keno capital 730,000. The next requirement would be, after the opening journal entry, is the statement of financial position. So for the statement of financial position, this will be our statement of financial position as of the date of formation. Sorry, let me just change this year. It should be 2023. So here it is, the statement of financial position. First, you will record cash, 766,000. So that's 36,000 and the contribution of Keno in the amount of 730. And then the value of the receivable here, 150 less 10,000 allowance. So you have a net realizable value in the amount of 140,000. Inventory, 460,000. Equipment, 124,000. And you will have a total assets in the amount of 1,490,000. Accounts payable, you have 30,000. Hispanol capital, 730,000. Keno capital, 730,000. And then your total liabilities and equity is 1,490,000. So we have accomplished here the required, which is opening entries in the book of the partnership and preparation of the statement of financial position. Okay. Now, in the event that you have any questions or clarification, so please raise those questions and clarification during our synchronous classes. Thank you for listening, and I hope you have learned something out of our discussion today.